So hi. So for the month of August, we have come out with certain data points which can help you out, understand what can happen going forward in this particular month and also going ahead also. Now, if you see, markets have recovered from the lower levels. When the market declined, then also there were some things, which were in favor of Indian markets. Indian markets outperformed the emerging markets. And in the market recovery also, we have seen that outperformance is quite visible. If you see this particular slide, where you can see both the tables here, the first one shows when the market was declining towards 15,200, that from the pre-COVID highs of 12,400, Nifty declined. Why? Nifty was still 22% higher when the other emerging markets were down. And these markets, they had some commodity producers also. So when commodities were higher, crude was higher, those markets should have attracted more FI flows. But even then, the market performance of Indian market has been quite resilient in comparison to them. If you look at from the post-COVID high of 18,600, from there also Nifty declined by around 18%, and these markets also have declined in line or a little higher also. And if you see the FII flows, in 2020, India had a very good high inflow of $23 billion. 2021, it was a little curtailed down, but still $4 billion on inflows were seen. Though from October onwards, the volatility arose, actually came up in Indian markets. 2022, India has so far seen $29 billion of outflows. But despite this, we have seen this resilience. You look at in the market recovery from 15,200 to almost now 17,000 plus levels, we have seen that Indian markets have again been one of the best performing ones. Our mid cap and small cap have again bounced back because these were the indices which were 22-34% down when Nifty was down by 18%. So they have recovered little higher actually than the index. So now coming back to some of the macros which are impacting the markets and which everyone is looking at nowadays. For example, US bond yields and US interest rates move. So US interest rates were 1.75% after the 75 bips of interest rate increase. And again, there has been another increase of 75 bips of interest rate increase, and now it has reached to 2.5%. Though the expectation near this particular meeting was building up that there may also be 100 bips of rate hike, and the probability for that actually was increasing very sharply. But because the commodities had declined and US Fed finally took the decision of curtailing down by 25 bips, and they increased by 75 bips again in the consecutive meeting. If you look at the bond yields in US, so they rather came down. So it's not like even after the 75 bips of interest rate increase, the bond yields have been rising. In fact, the bond yields made a high around 3.5%, and now they have declined. So why it is happening? Because markets, they factor the things beforehand. Bond yields were factoring the interest rate hike of 3.5% by December ending. That is why the bond yields moved to 3.5%. And when now the things are happening by the month of August, it is already 2.5%. It is possible by the end of December, what the market is expecting, there may be another 1% interest rate increase. So bond yields have already done that particular move. So they are now cooling off despite this interest rate increase. And that is one of the reasons why the markets, equity markets have also recovered, because equity markets follow the bond yields. Sharp move in bond yields on the higher side generally leads to declining equity markets. But now the reverse is happening because bond yields are softening. So equity markets are seeing some kind of recovery. But still, one fear factor in the market is that the recessionary scenario can be seen when we are seeing so sharp increase in interest rates. It is possible some kind of recession or slowdown can be seen in the economies. So in US, there is one indicator which has been sustaining and showing some kind of belief that some recession may be there, and that is the yield curve inversion. So 1 year around, if you look at the bond yields, they are around they are more than 3%, could be 3.05, 3.08, but the 10-year is around 2.7. So there is more than 30 bips of difference where the short-term interest rates or bond yields are higher than the long-term. So this is a scenario which indicates that not a very healthy sign for economy, and generally it is seen as a recessionary indicator. So we have to see how this thing pans out actually over the period, but definitely some kind of slowdown, these kind of things can impact, and we should be ready to, with our equity portfolios going ahead, to face such kind of volatility. When you look at from the Indian economy perspective, the things are picking up very nicely. Our GDP has already crossed $3 trillion. We are now $3.17 trillion. Our index earnings are continuously growing. In Nifty EPS, if you see now till the June quarter ending, so EPS has been continuously rising, though the pace was little higher actually before. Now the pace is not that much higher, but still it is not like these EPS are getting downgraded. Still you are seeing broadly they are either in line or they are inching up, which is a good sign. So that means if the market sometimes are seeing profit booking, that creates an attractive scenario from the price to earning perspective if the earnings are healthy. From the export perspective, the things are coming better actually, though the people are talking about recessionary scenario outside, but exports are doing better in India. Overall basis, there may be some hiccups for 1 month or 2 months, but broadly, if you see, Indian in financial year 22, $670 billion of total exports were seen, where the services exports was around $250 billion and merchandise export was around the remaining of $420 billion. So this is the merchandise export, which has improved actually from in the last 1 year or 1.5 years. Otherwise, it was broadly flat from 2012. So 2012 till 2020, it was around $300 billion. But now post the pandemic, we have seen that this recovery has started very well. It may be a pent-up demand which came up initially, which is keeping it higher. But yes, there are certain segments like refining products, petroleum products, engineering goods, jewelry, these segments actually have revived very good. Engineering goods has also revived very good in terms of exports. And the other part of services, so obviously software export and all this has recovered, and we have seen it has moved to $250 billion now. So both these segments are well placed. And we have to see going forward, if any recession or slowdown happens in the developed markets, how does it impact? So far, there is not any noteworthy sign which we can talk about. If you look at Brent crude, which was a problem because it moved to 120 plus $120 per barrel kind of levels, but now it has slipped. There was recently a meeting of OPEC Plus where they announced very low 1 lakh barrels per barrel of output increase. So this was not very significant, but still in the last meeting, there was an increase which was higher than the market expectation after Biden, the US, had met the Saudi Arabia head. So that time the crude started coming under pressure. And there is obviously because there has been some talk of economic slowdown going in the abroad. So that also led to some decline in the demand perspective or expectation of decline in demand, because these are all markets which are factoring what is going to happen in future. And that may be one of the reasons why crude has declined recently, which is good for India overall, because we are one of the major importers on our total imports. This is one of the highest import scenario commodity that we have, around 80%. So obviously for India recovery, this is one of the vital factor that crude remains around 80 or 90 dollars per barrel around. So that is something which is happening good for India right now. If you see from the dollar perspective, because this was another variable which was impacting our currency. So rupee had depreciated to 80 rupees actually in the USD INR. But we have seen now that the dollar index, which has moved to 108, now it is getting tapered. It declined to close to 105. Now it is 106 around. And because of that, we have seen some cool off in the emerging market currencies. So like rupee was around 80 something, then it declined to 79. So some cool off is seen because of this tapering of dollar. And it has happened because after a long time, ECB has increased the interest rates. It was long awaited, though their inflation was moving up, but they did not have courage to increase the interest rates because their economy was looking like, it is looking little more vulnerable actually. But they have increased. Their focus is to curtail down the inflation. So 50 bips of increase is seen from the ECB. We have to see going forward how much or how many increase, number of increases they do actually going forward. So, but because euro has almost 58% weight in dollar index, that is the reason when euro was declining, dollar was appreciating. Now, when interest rates are increasing, there may be some appreciation in euro, which can taper some dollar move. But it all depends upon number of rate hikes by ECB going forward. From the monsoon perspective, in the domestic market, the things are looking much better. We have seen that our rainfall in the month of July has been much better than the average rainfall of the last 30-50 years. And July month generally remains very vital for the overall monsoon. In a season, July rainfall generally contains around 35% of the rainfall. And if it is not good, then it definitely impacts the rainfall percentage. But this time after June, because June the rainfall started with a delay, there was 8% deficiency, but in July it has recovered to almost 10%, higher than the long period average, which is really good. If you look at the reservoir levels right now in India, in various regions, so they have been higher than the last year, which is again a positive sign. It looks like the rainfall is being spread out evenly in various regions, though some regions still are lacking behind, like northern part, some part of northern area, and in the eastern part. But it is expected now that the rainfall there will also pick up. So there, whatever deficiency is there in paddy, rice, some part of it can be recovered now from the crop perspective. Food inflation, because of the healthy monsoon, we are seeing, it is tapering off, whether it is cereals, pulses, all of these crops, cultivation has become very good. Our total cultivation is almost the same what we had last year at the same time, which was also record last year. Then, and overall, if you see chicken prices, wheat prices, they have cooled off. Palm oil prices have also cooled off. And as I said, rice and all. So we are just looking forward when the paddy cultivation can increase. If you see from the bank's perspective, because it has been very significant increase in credit growth in Indian markets in the banking system in the month of July. So it has almost reached to 14.5%. It is very encouraging to see this kind of number, because last year it was just reeling around 5%. And there was lot of worries in the system that how the banks will start, doing the shape up going forward. But with this kind of credit growth, the scenario looks much better now. And if you see the NPAs on a base of 100 lakh crores, just 4-5 years back, we had almost 12 lakh crores of NPAs. But now on a base of 120 lakh crores, it has come below 6 lakh crores now. So in fact, it is 5.9%. So NPAs have also declined. And this is one of the reasons why the earnings of the banks are coming better. In this particular quarter, whatever results came out, we have seen that the bottom line of the index has been maintained by the banks. Because the non-banking system is still, the margin pressures were there. So some margin, have deteriorated some of the profitability, but in the banking system, the PAT has remained quite strong. GST numbers have continued to remain above 1.4 lakh crores. This is definitely a positive sign. What government has expected in financial year 23 on a monthly basis that it will be 1.3 lakh crores. So obviously it is coming higher than that. And we will not be surprised if this number further increases. And now, because just 2-3 months back, more than 20 crore turnover corporates, it has made mandatory for them to do the digital invoicing. So I think this is one footage for the government, which is coming good and which is really helping the government to continue with their capital expenditure plan. If you look at the capital goods companies in this quarter, they have projected that overall the order book rise more than 80% also is seen. So which is a very healthy sign, and it looks like more public expenditure is helping the capital goods companies. It is coming out as one of the best sector right now in the Indian markets. Now, whenever the 8 core industries data comes out, if you look at whether it is, these are all the 8 core industries. If you see petroleum refinery, fertilizer, steel production, cement, electricity generation, we had seen one of the all-time high figures in the recent period, which is also some, which talks about the demand factor in the economy and which is quite buzzing. And it looks like whether it is the urban area or the rural area, which was a laggard, it looks like there is some recovery actually there. And that is one of the reasons why the fertilizer production also has come up better. Cement production, which generally remains little laggard in the monsoon season. And it is expected that going forward after 1 or 2 months, this figure can further improve, I think, going forward, because the capacity additions already are coming quite sharply in this particular sector. The current capacity utilization from the last December 2021, it was 72%. Now it is reaching closer to 75%, which means the capex cycle in certain industries has already started. Metal companies, they have already announced 1 lakh crore of capex, which is also leading to some credit growth in the banks. Another important thing is the services sector, because services, if you look at when we are coming out of the 2 year of lull period in pandemic, there are many industries like hotels, like tourism, like airlines. So they are, reverting quite sharply, because PMI services in India, it almost reached to 60. It was close to 59. This month there is some decline, but it is around 55 now, 55, 56, but it's still anything above 50 is an expansionary scenario, and it is not happening only in India. You look at the figure of US, which has come recently, which is above 55. Even China, which was under the lockdowns, there also the PMI services has moved above 55. So all of these economies, it looks like they are opening up, which is a positive sign. And I think there are certain industries which were not performing before, and because of the hidden capital, discretionary expenditure which is coming out from the customers, I think that will help these industries to grow in the coming days. And that is also we need to be, we need to look for when we are forming the equity portfolios. Also in India, we have a festival season now. So we will have Ganpati season here, and then Diwali, and then New Year. So I think the consumer discretionary should start coming good. In fact, we have seen a good volume growth also in this particular quarter, despite some margin pressures in the consumer discretionary already. So this is what I was talking about, that PMI services has increased in US, in China also. The jobs data in US also has come better. So these are the signs which are so far negating the recessionary scenario, which is shown by the inverted yield curve in US. So we have to see, how the things are shaping up. So this all depends upon the data points which will come now going ahead. Volatility factor in India as well as in US, it is still in control. We have seen that the volatility indices, which are generally taken as a fear gauges, so they are cooling off. And that is one of the reasons why the equity markets have shown good performance from the lower levels. Now, coming to one important factor of steel. Now, what has happened when the government put a ban of 15% actually on the steel export, and the prices were coming down on the domestic market. It declined from almost 77,000 to 59,000 per ton. The production of the Indian producers actually has declined. So if you see the China production recently from Q1 to Q2 calendar year 2022, it moved up from 246 million ton to 280 million ton, while in India it has decreased from 32 million ton to 31 million ton, and that is the reason this particular and higher production by China, and also because in China the consumption demand is lower because of the problems what we have seen in real estate, which contributes more than 30% to this particular sector. And we have seen that because the consumption demand was lower, their export actually has increased. So if you see, these are the export numbers of Q1 21, calendar year 21, Q1 calendar year 22. You can see that the numbers from Q1 to Q2 have increased in China, and the numbers in India has actually declined on the export front. So China is benefiting from this export ban, what is imposed actually on our companies recently by the government. To some extent, their numbers in exports have increased, and that is what impacting the Indian steel companies. I think the way ahead will be that these commodities possibly can remain lower for some time. They will take time to recover, but eventually our sense is industrial metals should recover going forward. But it may take some time for the timing, because the recessionary talks right now, they are putting some kind of pressure on the commodities. Now, lastly, one of the pick in our ACE equity portfolio, it has given more than 100% of returns. So we took Mahindra in our portfolio around 600 levels. You can see here, Mahindra was taken at 600 last year, or 2020 ending. We took M&M actually in the portfolio, and now it has moved above 1200 levels. So it is one of the superb recommendation and call that is taken in ACE equity PMS, and one of the major contributor to our success story so far. And why we took Mahindra? Because when we took Mahindra, we met the management. The management was very clear that the return ratios in the company will be increasing going forward, because they were focusing to cut down the subsidiary losses, which they actually did. It was more than 3,000 crore. Now it has reduced to 100 crore now, the subsidiary losses international. Their market share in their tractor space has remained quite robust. And tractor is only one automobile segment which is above the 2019 base. Otherwise, if you look at passenger vehicles and two-wheelers, they are still down than the 2019 base. Another thing, in the electric vehicles, this has been on the forefront. Mahindra, it already came out with a three-wheeler Triazor. Now recently they have done a joint venture with a British company, and which is almost pegged at $9 billion going forward as in terms of valuations. So that is the something. Now, if you look at the ROEs, the return ratios of the company, from 12 to 18%, the management is guiding, which is a much significant number actually going forward. And that is the reason why the stock has been buzzing. One of the best performing stock in the automobile space. When we look at the intrinsic value of Mahindra, then considering all the subsidiaries here, we have seen that the market price actually is coming somewhere around, the intrinsic value is coming somewhere around 1,500. And I think this is something that we need to look at, in some of the auto companies. Mahindra has remained low volatile or, low beta stocks historically, but it is coming out of shell because of these fundamental triggers. Almost, volume growth of 15-16% we are expecting from 22 to 24. And I think going forward, it should remain buzzing actually, and one of our success story in ACE equity PMS. So that is all from my side for the month of August. That is all, I can share. I think going forward, how the markets are going to behave. We have already seen a lot of time correction in the market in the last 1.5 years. And it looks like some kind of recovery is there. And as I said, we are entering into the festival season also domestically. So I think it will be more driven by the domestic oriented things, because globally many things are already done, announced. Fear factor is there, I understand, but market is also absorbing the fear gaze. Volatility index, we have already seen it moved up and now it is cooling off. So they are also absorbing the fears created by the macro headwinds globally. So I think the domestically we need to look at more when we are looking at the equity portfolios. And this is what we have done in the AS equity PMS also. We have a good exposure to B2B companies because the inflation still remains a worry. So B2B companies are doing better in that segment. The domestic oriented capital goods companies, or or some of the telecom companies, or some of the corporate linked banks. So these are the stories that will drive the portfolio returns going forward. So thank you very much. This is all from my side, and have a good month going ahead. Thank you.